Can you hear me?
I can hear you clearly.
Yeah, just come in, please.
Sure.
CNBC TV 18, celebrating 15 years of leadership.
Welcome back. The market's on a strong wicket, you will have to say, actually building inch by inch, and that's a pleasant sight to see after the kind of ravages we saw on the Sensex, the Nifty and the mid-caps last week. The advanced declines, 4 stocks in the green for 1 in the red, 80% of the market higher than where we left off on Friday. Mid-caps still racing ahead, 1% higher. Pleasant spot to be in. The interest rate sensitives are not the best place today. Bank Nifty is up just about 0.6%. But on more broader issues, an expert from, of course, the finance space itself and, of course, the big man from HDFC, K.K. Mistry, Vice Chairman and CEO of HDFC, joins us. Good morning, Mr. Mistry. Thank you very much for joining us.
My pleasure.
First up, let's clear out some things that have been floating around on HDFC Life. We understand an IPO is in the offing. You want to comment on that?
Sure. We've always said that we are keen on doing an IPO, but the timing of the IPO certainly has not been decided. We have not appointed bankers. We have not decided how much the IPO would be, when it would take place. So it's all premature. But yes, IPO per se, we are very, very interested in. First thing what we would do is in April, we have a meeting with Standard Life for our partners in the life insurance business. I think that's happening around the 20th of the month, and that is the time when we take a call on how much Standard Life increases their stake to, and then subsequent to that, when the IPO would take place and how we would, what kind of shares we would put in the market.
Okay. Well, we asked you this earlier, but surely you would have touched base with Standard Life already. Is there an indication that they want to top up before you go do an IPO?
They certainly will want to increase their stake a little bit beyond 26%, but how much further they will go up to, that's the call which they have to take.
Okay.
That's not decided.
Okay. All right. Mr. Mistry, hi, good morning.
Morning.
Good to hear from you as always. Can you give us an indication of what's happening with wholesale funding costs? How much have they fallen in the last, say, 3 to 4 months, and are they expected to fall further?
See, my sense is, Sonia, March is never a good month to look at interest rates. Because March is the time of the year when every year, irrespective of which year you look at the last 20 years, barring maybe 1 or 2 occasions, every other year you will find that interest rates tend to spike a little bit in March. Now, having said that, interest rates have not spiked this time, but having said that, they are a little tighter. Money is a little tighter than what it was in February. It's still not bad. It's very good actually, but it's a little less easy than what it was, say, 3 or 4 weeks earlier. And the reason for that is that on 15th March, you have a huge amount of tax which gets paid for 40% of the taxes of the year, irrespective of whether you're a company or an individual, you're a whatever, a charitable trust. You pay 40% of your taxes on 15th of March. So a lot of liquidity gets sucked out of the banking system. It goes into government coffers. The government really starts spending that money into the new financial year. So there's a little bit of tightness at this time of the year. So if you were to compare this with, say, 4 months earlier, yes, wholesale rates have come down. But my sense is that I said at the beginning of the year, I think your program sometime in December or January, that in my view, during the course of this year, we'll see about a 75 to 100 basis points decline in rates. When I said a year, I meant a calendar year. And of that 75 to 100, we've already seen 50. So I still believe that there is scope to cut another 25 to 50. But I'm not sure of the timing. I don't know whether RBI will do it in April or they will wait and then look at cutting rates later on.
Okay. I just want to get another RBI issue out of the way. This doesn't affect you all at all, but do help us understand. We already know that the NPL number, the NPL recognition threshold will move to 90 days for all NBFCs by March 2018. What was it that RBI was telling us on Friday night when that bunch of notifications came?
I don't know what these notifications were. I don't know the details of those notifications. Okay. But yes, for housing finance companies and banks, we have been following a 90-day recognition of NPL for the last almost a decade. And now for NBFCs also, they are moving to a 90-day recognition norm. But I'm glad that it's been done in a phased manner. So it's not that you suddenly get a shock and then from 180 days you have to move to 90 days in a very short time span. So here there is enough time for the NBFCs to plan their numbers, plan their strategy, and work towards ensuring that the 90-day number does not create too much of a concern in the market.
Okay. What could the expansion in retail spreads be going ahead? Given that the lending rates are stable at this point, and we are expecting to see at least a moderation in wholesale funding costs.
See, my sense is, Sonia, as first of all, you need to understand that as the rates come down, there is no immediate reduction in cost of funds for the entire balance sheet. The reduction in cost of funds happens on incremental funding. Any additional borrowing you do, that would come at a lower rate. But the existing borrowing rates don't change because they are linked to some other benchmark or they are fixed rate or whatever. So it takes a while before the reduction in interest rates percolates into the entire liability structure to reduce it enough to drop rates. But my sense is in the course of the next few weeks you will see some transmission happening and you will see some reduction in rates. Spreads, if you look at it historically, irrespective of periods of time when rates have gone high or rates have gone low, our spreads have generally remained constant because we keep a match balance sheet. Whenever we find that there is sufficient reduction in cost of funds to warrant a reduction in lending rates, we do a reduction in lending rates, and vice versa. Whenever there is an increase in cost of funds, we pass on that higher cost to our customers. So my sense is that spreads have remained stable in the range of 2.25 to 2.35%. I don't want to get into specifics for the quarter, but if you were to look at the December numbers, which are in public domain, our spreads as of 31st December were 2.31%. So they were right in the middle of, slightly marginally about the middle of that band.
I'm a little surprised you said that rates will fall in a few weeks. I thought in a few days, many people were guessing at the start of the slack season.
Well, a few weeks would also include days, doesn't it?
Okay. There would be a little more, many more days. No, is it not early April that you're smelling the first moves?
It is possible that one could see some reduction in rates happening in April itself, but whether it will happen in the 1st of April or 10th of April, I don't know. Because, March is the year-end. Everyone is sort of trying to get their numbers in order, and then sometime in early April, people will look at the balance sheet, look at the cost of funds, look at their ALM structure, and then take a call on when to reduce rates. So my sense is it's a matter of days, stroke weeks, whatever you call it.
Okay. As and when HDFC Life does its IPO, will HDFC be selling stake or will it be new shares?
See, this is again something which we will have to discuss. We have not discussed this. It depends on the capital needs of the company. For regular day-to-day growth, my sense is they don't need capital. But if there was an acquisition opportunity or if there was a M&A opportunity, then yes, it could be fresh capital into the company, or part of it could be fresh capital, part of it could be a sale of shares by HDFC. So it depends on, really we haven't taken that call. But as things stand now, certainly a bit of it would be sale of shares by HDFC, if not the entire lot.
Okay. That means something is on your radar in terms of inorganic moves?
Not at the moment, but it's always very good to keep some amount of cash in hand to take a call if an opportunity arises. And there have been a couple of opportunities opportunities in recent times. Unfortunately, they did not culminate into a transaction for a variety of reasons. But there were two opportunities in the last 12 to 18 months, which are in public domain. So.
Yes.
Okay. What is the situation on the ground, Mr. Mistry, in terms of demand? Has demand picked up on the retail side? And what kind of growth? Because, we don't hear any concrete pickup in demand from other players in the industry. But what kind of mortgage growth do you see, say, in the next 6 to 12 months?
See, irrespective of times, irrespective of whether the economic growth was strong or weak, if you were to look at data over the last many years, you see that we've had a growth of upwards of 20% in our loan book after the ad-back loan sold in the last 12 months. So the point I'm making is that in the last quarter or 2 quarters, I don't want to get into quarterly numbers, but in the last 2 or 3 years when the economic growth was weak, we did not see a slowdown in demand for individual housing loans. In the non-individual component, yes, there was clearly a slowdown. So if you were to look at the split of our lending between retail and non-retail, incrementally, individual loans in the 9 months up to December 2014 contributed as much as 85% of the increase in the balance sheet, increase in the loan book, whereas the non-individual component was only 15%. And this 85 is much higher than the book number, which is 65-35. So clearly, individual business did not slow down in the last 2 years. Non-individual business did slow down. And as the economic activity picks up, as the investment cycle improves, which I'm confident will happen in the course of the next 12 months, my sense is that the non-individual business will also see a pickup.
I was so sure you're going to give these numbers to us in terms of HDFC always giving us this 20%, 25% growth. I almost wanted to snatch Sonia's question and give it a caveat. Mr. Mistry, what Sonia is asking and what everybody would want to know is what the industry will do. You guys will always deliver on expectations, but what is the loan demand in the industry growing? As well, the split exactly. Are wholesale guys at least turning the corner? Are you getting some demand at least from non-Mumbai and non-NCR regions? Are things better for the real estate space?
See, if you ask me on the real estate space, first of all, if you look at the data, the RBI numbers for, I think it was for the month of January, which is the latest data which is there, the growth of housing loans in the banking system was 16%, 1/6. And traditionally, if you take the last 7, 8, 9 years, this growth has ranged, I'm talking of the banking system first, the housing loans in the banking system, this growth has ranged from about 11, 12% on the low. It's been as low as 7 in some years, but it's been as high as 19 or 19.8. So it's at the higher end of that band in the first 9 months. Demand from developers is always there. It's just that, we have to be that much more cautious, that much more careful with our lending, and we don't want total loans to developers to go beyond a certain size. If you talk of Mumbai, it's not that Mumbai has slowed down. If you look at the outskirts of Mumbai growth has been fairly strong. Central Mumbai, South Mumbai has been relatively weak, but that has never been a big market for us. So if you look at us, look at our lending, our average loan size in the current year has been about, current year meaning up to December, has been a little over 23 lakhs of rupees. So if you take a 23 lakh rupee loan and a 65% loan to value ratio, we are typically catering to middle income, below middle income type customers. And that is not the type of people you will see in Central Mumbai or South Mumbai.
Okay. All right, Mr. Mistry. Before we let you go then, you were telling us that you expect another 25 to 50 basis points cut by the RBI. So what about the April 7th policy itself? Anything expected there?
My personal view at the moment is no. Okay. Because RBI, my sense is RBI will want to see what the impact of the unseasonal rains we've had has been on the food production and on inflation numbers in the course of the next couple of months, and then take a call. But wholesale inflation numbers we've seen has come down significantly. It's down to negative territory now for the last long time, and last couple of months at least. Consumer inflation continues to remain a little high, and it's not healthy. It's still on the upwards of 5%. And the reason for that is that some of the structural issues which have been plaguing us over the years in terms of supply-side constraints, unless those issues are addressed, inflation will remain, will not come down to the level one would like to see. And that can only happen by investment in infrastructure. And that is why I think the government has done a great job in putting aside the 70,000 crores into investment in infrastructure, particularly in projects which have a short life, where the turnaround time will be faster and the multiplier effect will be a lot quicker.
All right, Mr. Mistry, it was a pleasure speaking with you as always.
Thank you, Latha.
Very much
Thank
for
you,
joining us.
All the
Thank
best.
you.
On the macros and of course that important clarification on the HDFC Standard Life. First, Standard Life has to come back and discuss about their stake increase, and only then will the IPO be known. It will be part, raising capital and maybe a little bit of HDFC booking profit as well and divesting stake. That's the key takeaway we've got on HDFC Life from Mr. Mistry. Let's take a break on that note. More on the markets in a minute.
CNBC TV 18, celebrating 15 years of leadership. CNBC TV 18 exclusive.
World Bank, multilateral agencies like them, like ADB, even private financing arm like IFC, and others are more than willing to give us.
But how much are they willing to commit, or have they committed?
They will give, I don't know, we are actually very advanced stage of negotiation. Particular projects will not be completed, all of them may not be completed in 1 year, but all these projects, because they have a life, maybe 2 years, some will take 3 years, some may happen in 6 months.
Okay, concrete now on the table as far as what you intend to do with that?
We were thinking about a securitization model for this, but as I told you, the money is already coming, so maybe we are keeping this, but also the other monetization ideas, essentially in terms of our corporate entity.
CNBC TV 18 exclusive. First in business worldwide. CNBC TV 18, celebrating 15 years of leadership.
Hi, welcome back to the show. Stable for the market, but Latha actually caught up with some bankers over the weekend. Latha, what's the sense you're getting on whether the bad loans crisis is now abating?
Well, the context of the discussion on Indianomics was exactly that. You know, there is some relief coming in for gas-based power plants which were actually languishing without any gas at all, and there probably 30% will start functioning before the year is out, or maybe even earlier, maybe before 6 months is out. A bunch of road projects are coming on stream. We have not heard about environmental problems becoming a roadblock in some time now. And then there are fresh orders expected from April 1st, when the government is expected to start spending. The last of the crunch on planned spending to bring the fiscal deficit down should logically be behind us. So the question really was, have we seen the worst of NPLs? And the heartwarming answer I got from 3 separate people, and who represent between them probably about 35% of the banking space. That is SBI's Pradeep Kumar, Ranjan Dhawan, the Managing Director of Bank of Baroda, and Srini Vardarajan, the Axis Bank Executive Director. The combined statement from all of them is that incremental NPLs are going to be lower. Okay. They agree that that incremental NPL is still not a source of comfort, that it is still large and they will be uncomfortable with it, but the big thing is that it will be a little less than what it was in previous quarters. That was kind of more or less the notes that all of them struck. In particular, Mr. Ranjan Dhawan said that actually he had seen a lot of people who have got mines beginning their work. So definitely he said that, you know, you're going to see a little more activity from trucks, you know, mining construction companies, those who do lease and hire purchase of hoists and cranes. So all those entities will start showing activity, because he actually saw more mines getting activated. That was his personal experience. And Srini Vardarajan also believing that, you know, incremental NPLs for the system as a whole will definitely be lower. The other point they made was, you know, there is a technical factor that could still increase NPLs for a couple of quarters, because the Reserve Bank rules change. From now on, you won't have 3 categories. You had bad loans, good loans, and a middle category called restructured loans, where the provisioning has to be higher than it has to be for standard loans, but lower than for NPLs. That category vanishes from day after tomorrow, April 1. You can't have a special category restructured loans. You can jolly well restructure, but they will be considered NPLs. Now, therefore, there could be a bump up in terms of NPLs, but the actual generation of slippages in the system is likely to be less. So that was the reply we got. Most of them expecting definitely from the September quarter onwards, the NPL numbers looking distinctly lower. Let's listen into a slice of that conversation.
The growth for credit is very, very muted for the last 3-4 quarters, and maybe it will continue to be so at least for the next quarter. Yes, the government, the Reserve Bank of India and all take a lot of incremental steps, and if you go by data of our bank especially, for the last 5 quarters, we have seen the slippages coming down, but still the slippages are very substantial. We are not in a comfort zone still, but yes, relatively maybe compared to last year, the slippages have come down quarter on quarter, which perhaps indicates the pain is slowly easing in the system. The steps that are being taken by RBI, whether it is 525 or conversion of debt into equity, easing conversion of debt into equity, availability of gas for the power plants, will all prevent perhaps more loans becoming NPAs. I do hope it will be down, but I will not be able to say it with great confidence it will be lower, but I think it is trending lower.
I believe that the pain would be there for one or two more quarters, but I think the incremental pain should reduce this quarter. Going forward, of course, the new dispensation of the RBI comes in, wherein all restructured loans are to be treated as NPA. So we'll have to wait and take a call for the first quarter of the next financial year. But for this quarter, I think we should be pleasantly surprised on the downward side.
the old stressed assets, the legacy stressed assets, which have still to be worked through, is something which will continue to be something which the next few quarters will sort of see some more pain. But incrementally, are fresh loans being added to that list? I would think that that is slowing down, and I think that is the good news here. On top of all the actions being taken by various stakeholders, I think fresh incremental stress loans accretion to that is clearly slower.
Okay, so that was a kind of unanimous view we got, that incremental bad loans would be falling.